Hey everyone, welcome back to Corporate Decoder, the place where we unpack those dense corporate filings to find the real story. Today we're diving into Biofrontera Incorporated's latest report, and let's just say there was some significant wheel spinning happening behind the scenes. Before we jump in, if you love getting unfiltered insights from these SEC filings, make sure to hit that subscribe button. And for more real-time discussions and to connect with fellow market watchers, join our Discord community. The link is in the description. Alright, so what we have here is an 8K filing. Think of an 8K as a company's way of telling the SEC and the public about any major unexpected news that could be important to investors. It is not a regular update like a quarterly report, but a special announcement for, you guessed it, current events. And the big news here revolves around a significant strategic transaction that wrapped up in October 2025. Biofrontera Incorporated, or the company as they call themselves, finalized agreements to acquire all of the US rights to two of their key products, Ameluz and Rodolud. This wasn't just a handshake deal, it involved an asset purchase agreement, which is basically a contract to buy specific assets, and an earnout agreement. This means they're buying these important drug rights from their former parent company, Biofrontera AG. It sounds like a big step towards the company becoming more independent and fully controlling these products in a major market like the United States. Now, this strategic move has been in the works. They had a previous filing back in July of 2025 that laid out some of the details. What is interesting is how they're handling the payments. Instead of a fixed price, there is an earnout. This means the company will pay a percentage of the US revenues from Ameluz. If the sales are $65 million or less in a year, they pay 12%. But if sales go over $65 million, that percentage bumps up to 15%. This replaces an old licensing agreement which is now terminated. This earnout structure is pretty common when a seller wants to ensure they benefit if the product really takes off under new ownership, but it also means the buyer's costs can vary based on performance. Beyond the main transaction, there is also a section about selling stock. This is about an unregistered sale of equity. Basically, they sold some preferred stock, called Series C preferred stock, not through a public offering where everyone can buy, but in a private placement. This is usually done with a smaller group of investors, often referred to as accredited investors, who are considered sophisticated enough to understand the risks. This private placement, called the Series C preferred offering, was structured in two parts. The first part closed in July 2025. The second part, the one that's relevant to this October filing, closed on the 24th of October 2025. They sold 2,500 shares of this Series C preferred stock at $1,000 per share, bringing in $2.5 million. The money from this private sale is intended to help fund the acquisition costs related to the strategic transaction we just talked about, and for general company business. Now, what makes this Series C preferred stock interesting is that it is convertible. This certificate of designation tells us the rules for this special stock. Holders of this Series C preferred stock can convert it into the company's common stock. The conversion rate is tied to the original share price and is rounded down. This means the investors who bought this preferred stock in the private placement could become significant shareholders in the company by converting their shares. It's important to note that these securities haven't been registered with the SEC for public sale. This is typical for private placements. The company has agreed to file a registration statement soon, which will allow these investors to eventually sell the common stock they get upon conversion. This process can take time, and there are specific deadlines they have to meet to get that registration statement approved. Here is a crucial update that ties everything together and is a big deal for any publicly traded company. Because of the strategic transaction and the private stock sale, the company now believes its stockholders' equity is over $5 million. Why is this important? Well, for companies listed on the Nasdaq stock market, there is a rule that they need to maintain a certain level of stockholders' equity to stay listed. Specifically, Nasdaq listing rule 5550B1 sets a minimum threshold. By exceeding $5 million, Biofrontera Inc. seems to be meeting this requirement. This is a critical point, as failing to meet listing requirements can lead to delisting and a significant drop in stock value. They'll need to keep an eye on this in future reports to ensure they continue to comply. Finally, the end of these filings usually lists out all the supporting documents. In this case, we see the agreements for the asset purchase and the earnout, as well as the purchase agreement for the preferred stock, and as always, Therese the cover page interactive data file, which is for the electronic tagging of the document. Looking at the big picture, Biofrontera Inc. is clearly making moves to solidify its US market presence for its key products. The acquisition of US rights to Ameluz and Rodolud is a significant strategic step, moving them from a licensing model to direct ownership in a crucial market. The earnout structure shows they're sharing the risk and reward with the seller, which is a pragmatic approach. The private placement of Series C preferred stock served two important purposes here. It provided much needed capital to fund this acquisition and, crucially, helped them meet the minimum stockholders' equity requirement to stay listed on the Nasdaq. This second point is perhaps the most immediate positive takeaway from this filing. It suggests they potentially averted a near-term delisting risk. However, we should keep an eye on a few things. The reliance on private placements for financing, while effective in this instance for meeting listing requirements, can sometimes indicate challenges in accessing traditional forms of debt or public equity. Also, the earnout payments means their future expenses are directly tied to the success of Ameluz. If revenue targets aren't met, the earnout payments will be lower, but if they exceed those targets, the company will be paying a larger percentage, impacting profitability. In conclusion, this filing paints a picture of a company actively restructuring and shoring up its financial position. The strategic acquisition is a positive step for growth, but the jury is still out on the long-term financial health and profitability, especially with the earnout component and the ongoing need to meet Nasdaq's listing requirements. Alright, that is our breakdown of Biofrontera Inc.'s latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.